Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Today we'll begin with the Fed and Fed Chair Jay Powell saying today that policymakers will likely have a difficult road ahead as they weigh further cuts to interest rates. Here is Powell speaking earlier to the Greater Providence Chamber of Commerce in Rhode Island.
Near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path.
Powell offered no hints on whether he might support a rate cut at the Fed's next meeting in October. Momentarily, we'll have some reaction from the Asia Pacific. First, we'll check in stateside with Rob Haworth. He is Senior Portfolio Manager at U.S. Bank Wealth Management. Rob, thank you so much for making time to chat with me. Let's begin with the Powell story here. Wouldn't call it a pivot necessarily, but can we agree that it's a bit of a recalibration toward balance?
Yeah, Doug, great to be with you. I agree. It is more of a recalibration. When we left the press conference last week, I think the market certainly felt that we were on a path for more rate cuts. And the Chair Powell's speech today certainly gave some indication that there's a little more equivocation around, do we really need another cut if he sees inflation being more of a problem than employment? I think, and we saw that today in the reaction in small companies relative to large, where they'd had a good run early in the day and ended up selling off quite a bit. So I think the market is a little concerned that Chair Powell may be equivocating a little more on that October rate cut.
So how do you feel about the inflation story as it relates to tariff? I guess the longer end of the curve has been pretty well behaved. So at this point, the market doesn't appear to be alarmed at all.
No, I don't think the market is alarmed yet about inflation, but it is something we're watching. And if we look, right, we'll certainly get more updates with PCE at the end of the week. But inflation has been notching higher. If we look at year over year rates of inflation, we've seen a couple of ticks higher. And looking back, say a quarter ago, we're definitely above the rates we were seeing a quarter ago. So that's something that could continue. It doesn't seem persistent at this point, but it is elevated, and that has to be concerning for the Federal Reserve with that inflation mandate that they have.
So in today's price action, the AI trade seemed to take a bit of a breather. I think there were some concerns about maybe tech being overbought, some worries as well about margin risk. How do you see the trade around artificial intelligence?
Well, certainly it's been a great run all of a sudden this year. I think if we were having this conversation a few months ago, Doug, we would have been talking about how challenging it was in artificial intelligence in April and May. And we turn around and all of a sudden technology, communication services are at the top of the heap again, with artificial intelligence leading the way. I think as we look at it, right, we're worried about elevated valuations, but when we look at the fundamentals, we see strong underpinnings here, right? We're seeing actual earnings, we're seeing revenue growth, and we're seeing an innovation that, while it may take time to develop as to where everyone uses it and where we use it every day and how does that get monetized, the investment that has to happen today is real and large and is going to spill over into many other sectors besides just, say, the hyperscalers who are trying to package that data and those models together.
We heard from Micron Technology after the bell, and the company gave a very positive forecast for revenue in the current quarter. Micron, as we know, is a big maker of those high bandwidth memory chips that are used in artificial intelligence computing. But I'm wondering if, perhaps in the near term, we were to get some indication of a misstep, a company linked to the AI space that provided maybe a slight indication that the mark is being missed. I'm curious to get your take on the vulnerability of some of these names to any slight disappointment.
Yeah, I think certainly valuations are elevated. There is room for a reset here in terms of valuation, particularly because it seems like we're priced to that perfection. Now, companies have been delivering, right? The revenues have been coming through. The orders have been coming through. But if we do miss out on that perfection, we may see a reset like we've seen earlier this year. Probably not the same magnitude, but there could be that reset until we find the level at which maybe orders are hitting, and that's kind of the challenge when we look at NVIDIA earnings and other earnings. The orders are clearly there. Maybe it's not hitting it could maybe not hit every segment of the market, and that may bring in a little more question as to the forward path.
When we talk about the AI trade, frequently we bring in the energy story as a part of the conversation. How are you feeling about some of the big energy names? Are they potentially a little stretched as well?
We don't think they're stretched at this point. Data is at the heart of this, of artificial intelligence, and that includes data centers and electricity to power those data centers just so we can run those large language models. That's an element of the market that is probably not run quite as far, quite as fast as some of the more well-known names. And that's investment that has to happen through time. So we would look to utilities, particularly those with mixed power generation, as one way to participate in this rally as they look to build out that capacity to support data centers in this AI endeavor through time.
Are you putting on hedges right now to protect against a little bit of downside?
No, we're actually in a glass half full environment in our view, where we're still overweight equity. If we have any hedge, we'd be watching inflation, and so we'd add inflation sensitive assets to portfolios as well. For us, the primary measures there would be Treasury inflation protected securities relative to owning just investment grade bonds. And then on the equity side of the ledger, we would blend in some global infrastructure, which offers that diversification in terms of utilities, midstream energy, trade and transportation, but you get to participate in kind of higher inflation through earnings growth in those companies. And we think that provides a little inflation protection in your portfolio, which you could need.
So are there foreign jurisdictions where you're primarily focused? Is it Europe? Is it more Asia right now?
We're more globally diversified at this point. We're looking across the spectrum. We're certainly seeing an uptick in earnings growth around the world. It's not quite as strong as U.S. earnings growth, but it is an improvement from where it's been. So we would look actually broadly across developed and emerging markets.
So I'm also wondering about where geopolitical risk enters your thinking. We've got the UN General Assembly here in New York this week. A lot certainly has been made of this gathering. Many things to talk about, not the least of which war in Ukraine. How are you feeling about geopolitics as a part of approaching markets these days?
Well, I think the good news for us, it's been horrible news for those impacted. I mean, our hearts certainly go out to those in Russia and Ukraine impacted by these conflicts, in Gaza as well. But the good news is, right, the market's been somewhat insulated from this because we've been able to work around it. I think getting to resolution will be generally constructive for the markets, and the markets can put it behind them. If there's some contagion or spread to that risk, we could have a near-term hiccup, but it doesn't seem like that's the case for now. But that's something we have to watch and be aware of, but not a base case and not a core of our strategy at this point.
So you mentioned the PCE, which we will get on Friday. We'll also have data in terms of personal income and spending. And I'm wondering, before we let you go here, how you're viewing the American consumer.
Yeah, I think the good news here is the American consumer has really been quite solid. We're along with Chair Powell, we're watching what's going on with the labor market. That softening is something that has us concerned but not taking action at this point. But incomes are up. We're not really seeing layoffs, right? Jobless claims remain low, and consumers are spending. The Johnson Red Book weekly year-over-year retail sales at 5.7%. Retail sales for the month of August came in fairly solid. So this looks like a reasonably healthy consumer that is holding up this economy to some great extent. And as long as they remain employed and their incomes continue to grow, even modestly, I think we're on solid footing. And that gives us that glass half full perspective on the economy and markets at this point.
So is the Fed, though, a little bit behind the curve, do you think?
I think it's not really for us to say at this point. I don't think that they've damaged the labor market just yet, but we know labor can be such a lagging indicator. But they're certainly tighter than they perhaps need to be, that there's room for them to get back to neutral. And I think that's certainly something we've seen the market cheer and we'd look forward to as well, right? There's room for them to get back into that 3.5% neutral rate for themselves. and that would be actually helpful to the economy as well.
Rob, we'll leave it there. Thank you so very much. Rob Haworth is Senior Portfolio Manager at U.S. Bank Wealth Management, joining us on the line on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Markets across the Asia Pacific are reacting to comments earlier from Fed Chair Jay Powell. He said the Fed will likely have a difficult road ahead as it weighs further cuts in interest rates. We got the views of John Authers, Senior Editor for Markets, and he's a Bloomberg Opinion columnist. John spoke in Tokyo with Bloomberg TV host Avril.
Let's talk about the Fed. I mean, when you look at what Powell said overnight, he's not saying anything materially new. He's flagging risks on both sides, inflation and labor market weakness. I mean, what do you make of the messaging?
Well, in the context of the Fed, the messaging continues to matter. He could have started making much more of a fuss about unemployment, and he's not doing that, and he is still seeing the situation as being balanced. We've had various Powell pivots, as they tend to get known, in his 8 years in charge. If he was very clearly convinced that he was going to need to keep cutting from here, he would be saying so. It looks to me as though he is somewhat more confident than he was a week ago. There's obviously immense amounts of politics flowing around the Fed at the moment. There's going to be an almighty battle over exactly how independent it's allowed to be once he stands down. But I think he feels that he's more or less back in control of the situation, or he wouldn't have been that open-minded.
Do you think they should cut in October?
Probably, but I don't regard it as a completely done deal. They say they're data dependent, and they should be. I imagine the data are going to move such that you do want to cut again, but the tariff input is in there in the inflation data. It's only very minor. If you see that begin to pick up very significantly, then you do probably have a picture, a very serious problem for the Fed when you've got stagflation, and they probably do have to arrest the decline there and then.
The other thing about tariffs and inflation is how China seems to be flooding markets with their goods.
Yes.
Are we already seeing these signs of this China shock 2.0, 3.0, and how severe might that be for Asian economies and perhaps markets?
This is only my third day here in Tokyo. I have heard about that from more or less everybody I've spoken to. So you can certainly see that this is something that's happening. It's something that was predictable. A lot of countries in this region have a pretty strong need to stay friendly with China, and they're unlikely to push back unless they really have to. You do ultimately have the possibility of very serious negative outcomes for the US eventually out of this. For the time being, the critical factor, which more or less ensures that the US isn't going to do anything, isn't going to change its posture, is that it's making a lot of money out of it. If you look at the revenues they've derived from tariffs, it's very impressive. It's getting on for a quarter of what they get from personal income tax already. That is difficult to forsake. It does make all the fiscal problems in the US that much easier to deal with. Of course, it means if you're taking that much revenue, it means you haven't had the desired effect of actually choking off imports, of protecting the businesses at home. But you are still making money. So I suspect the US is locked into this path for a while, and everybody else is going to do, led obviously by China, by far the most powerful economy outside of the US. Everybody else is going to do exactly what you think they would do, which is find somebody other than the US to sell to.
When it comes to revenues, it's tariffs, maybe also chip revenues for the US, maybe H-1B visas as well, to some extent. How much does all this help to allay the concerns on the long end of the curve?
Oh, that's an interesting one. I guess it does help a little. Well, you just need to look at the performance of the long end of the curve in the last month or two. The risk of a big jump beyond 5% is, definitely looks much lower for the time being. Again, a lot depends on exactly how companies and the economy accommodates the tariffs. If you do see a renewed pickup in inflation, that's going to make people very concerned. If you see a successful push for much lower rates, i.e. if you see the Treasury, the government, forcing people to lend them at low rates, obviously they really can have some degree of impact over the short end, and you would therefore expect the long end to rise. So in itself, yes, it definitely does alleviate the pressure on the long end. And this is one of the big things you have to say. The Trump administration wanted a weaker dollar, lower long bond yields, and cheaper oil. And it's getting all of them, which for the time being certainly explains the degree of confidence you have in the US that they can continue doing what they're doing.
So taking some of the boxes that the Trump administration wants in terms of market reaction, what about when it comes to investment pledges? I mean, we're here in Japan.
Yes.
Hundreds of $1 billion worth from both Japan and South Korea that are being asked for, but light on details. We had the immigration raids in the US on South Korean factories. I mean, how realistic are you expecting these pledges to come in?
I'm not. Really, I mean, this is the thing about any trade deal like this. The World Trade Organization deals with, they had 2-year cycles between the major WTO meetings because that's how long it takes to thresh out the details of a real trade deal with all the definitions that are involved. I think the last I heard, NVIDIA still don't know the details of exactly what revenue they're going to be coughing over to the US, for example, and that's the biggest, most powerful company in the US. Still doesn't know exactly what the deal is with its own government. The Japanese and Korean governments don't need my advice. I wouldn't be I wouldn't be relying on any deal like that, and I would definitely be continuing, if I were them, with Plan B of working out a way of surviving without doing so much business with the US. You mentioned H-1B visas. Again, it's early days in the response, but my impression at the moment is that if you're really going to have to pay $100,000 to bring somebody over to do skilled work in the States, that will work from the point of view of helping US workers. It won't raise them any revenue. It just means that a lot of people are going to have to find ways to deploy themselves in their home countries. Yeah,
and companies and workers are going to be doing that cost-benefit analysis as we go as well.
I mean, it could be perversely good for the likes of India and China, but it's certainly a mess for the foreseeable future.
John, it's been really great to chat with you. Thanks so much for your insights. Our senior editor for Markets and Bloomberg Opinion, columnist John Authers.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.